silver is crashing. Prices have fallen from record highs, down more than 15% in 72 hours. And yet, a former JPMorgan executive is warning that the system is under more stress than at any point in decades. How can both be true? If you want to understand what's really happening in the silver market and why it matters, hit the like button, subscribe, and turn on notifications. You won't want to miss what comes next. Let's begin with what everyone can see. On December 29th, 2025, silver touched an all-time high of $84 per ounce. Within hours, it had collapsed to $72. The crash was violent, the steepest single-day plunge since September 2020. Billions in margin calls, forced liquidations across multiple exchanges. The financial press called it profit-taking, year-end volatility, thin liquidity in holiday markets. All true, all insufficient. Because while prices were falling, something else was happening. Something the headlines missed. The London silver market, the heart of global physical trading, remained in chaos. Lease rates, the cost to borrow silver for delivery, stayed elevated. Backwardation, a forbidden signal in monetary metals, persisted. And Robert Gottlieb, the former head of precious metals at JPMorgan Chase, was telling anyone who would listen that there is no free-floating silver left. Let's be clear about what we're discussing. This is not about whether silver goes up or down next week. This is about whether the pricing mechanism itself, the system that has governed silver for 50 years, is breaking. Markets don't reflect truth. They reflect reaction. And what we witnessed at the end of 2025 was not a normal correction. It was the collision of two incompatible realities. The paper market, where silver trades in contracts and leverage, said prices were too high. The physical market, where actual metal changes hands, said there isn't enough to go around. One of them is lying. Let's talk about who is sounding the alarm. Robert Gottlieb spent decades inside the machinery. Managing director at JPMorgan, head of precious metals, he ran the silver desk when bullion banks controlled the market with absolute precision. He knows how the game is played. He knows what it looks like when it stops working. And in October 2025, Gottlieb went public with a statement that sent shockwaves through the industry. No free-floating silver left. Not scarce, not tight, gone. The available inventory, metal that can actually be borrowed, moved, and delivered to settle contracts, has been depleted. What remains is locked, in vaults, in exchange-traded funds, in industrial stockpiles that cannot be released without disrupting supply chains. Gottlieb is not a retail commentator. He does not sell newsletters. He does not run a YouTube channel. When insiders like him speak publicly, it is because something is breaking, and silence is no longer an option. Now, some will point to Gottlieb's history. He was named in lawsuits. JPMorgan paid nearly $1 billion in penalties for precious metals manipulation. Gottlieb was questioned under oath. He was described in court documents as controlling decision-making for JPMorgan's silver positions. And yet, no personal criminal conviction, no sentencing. He walked away. And now, years later, he's resurfaced, not as a defendant, as a market sage, warning of the very stresses his former employer may have helped create. Does that make his warnings less credible or more urgent? Because the man who once operated inside the machine is now saying the machine is breaking. Let's talk about silver lease rates. If you don't understand lease rates, you don't understand what's happening. A lease rate is the cost to borrow physical metal for a set period. It represents availability. In normal markets, silver lease rates hover near zero, sometimes negative. Because silver has been abundant, there's always been enough, always another vault, always another bar. But in October 2025, London silver lease rates spiked to 39%. 39%? For perspective, that is roughly 7 times the typical level. Bloomberg called it panic. Analysts called it acute scarcity. And even after the October squeeze eased, lease rates never fully normalized. By late December, they remained between 7 and 10%. Still multiples of what is considered normal. Still flashing red. Here's what that means. If you are a bullion bank and you have sold silver you don't own, which is standard practice in the fractional reserve system that governs precious metals, you need to borrow metal to deliver against those contracts. When lease rates are near zero, this costs you almost nothing. And when lease rates hit 10, 20, 30%, it becomes prohibitively expensive. At 39%, it's not a market anymore, it's a scramble. Prices can fall. But if metal is hard to find, the system is under strain. This is the paradox, and it gets worse. Let's talk about backwardation. In a normal commodity market, futures prices are higher than spot prices. This is called contango. It reflects the cost of storage, insurance, and financing over time. If you want silver delivered in 6 months, you pay a premium over today's price. That's how it's supposed to work. Backwardation is the opposite. It means the spot price, the price for immediate delivery, is higher than the futures price. It means the market is willing to pay more for metal now than for a promise of metal later. In industrial commodities, backwardation happens. Oil, copper, wheat. It signals temporary shortages. But silver is not just an industrial metal, it is a monetary metal. And in monetary metals, backwardation is rare, forbidden even, because monetary metals are supposed to be fungible across time. An ounce today is an ounce in 6 months. There should be no premium for immediacy, unless there's a problem. In October 2025, the London over-the-counter silver market went into backwardation, spot traded above futures, not by a few cents, by dollars, and not just for the near month. The curve was inverted years forward. The market was screaming, "Don't promise tomorrow, deliver today." This is not speculation, this is observable. Traders moved metal from New York to London, and back from London to New York, arbitraging the spreads, exploiting the dislocations. The premiums in Shanghai rose above $8 per ounce over London prices, the widest spread on record. Physical silver, in certain markets, was trading as if it were a different asset than paper silver. The market is saying something. It's saying trust is weakening. Now let's talk about paper silver versus physical silver. The modern silver market operates on a fractional reserve model. For every physical ounce in a vault, there are multiple paper claims, futures contracts, unallocated accounts, synthetic positions. This works as long as not everyone asks for delivery at the same time, as long as trust holds. But when lease rates spike, when backwardation appears, when vaults start running low, the question becomes unavoidable. What happens if everyone demands delivery? The answer, historically, is that the exchange changes the rules. In 1980, when the Hunt brothers tried to corner the silver market, the COMEX introduced Silver Rule 7. It raised margins, it restricted trading to liquidation only, and silver collapsed from $50 to $10 in 2 months. The exchange broke the squeeze by making it impossible to continue. In December 2025, the CME raised silver margins twice in 5 days. First from $22,000 to $25,000, then to $32,500. A 50% increase in the cost to hold a futures position. In 1 week. Think about what that means for a trader. You wake up Monday morning, you're holding 10 silver contracts. Your margin requirement was $220,000. By Friday, it's $325,000. You need to come up with $105,000. Cash. Immediately. Or your broker liquidates your position, whether you want to sell or not, whether the market is moving against you or not, whether you believe in the trade or not. The margin call doesn't care. The result was predictable. Forced liquidations, a cascade of selling. Prices plummeted from $84 to $72 in a single session. This was not orderly profit-taking. This was mechanical, algorithmic. When margin requirements rise, positions get liquidated automatically. The selling feeds on itself. Stop losses are triggered. More selling, more liquidations. And the price drops, not because the fundamentals changed, but because the rules changed. The CME called it normal risk management, a response to volatility. Advisory number 25-393. Effective after the close of business, professional language, bureaucratic process. But traders saw something different. They saw the exchange stepping in yet again at the moment when physical demand was overwhelming paper supply. They saw the margin hikes as a tool, not to manage risk, but to manage price. Others called it something else, market manipulation, a coordinated effort to suppress prices, to protect the shorts, to prevent the physical market from overwhelming the paper market. We cannot prove intent. We can only observe outcomes, and the outcome was clear. The rally was broken, the squeeze was crushed, the paper market reasserted control. For now, we don't know the truth, but we know the pattern. When silver rises too fast, the exchange intervenes. Every time. 1980, 2011, 2025. The playbook never changes. Raise margins, force liquidations, break the momentum. And the skeptics say this is responsible regulation. The believers say it's manipulation. The truth might be both. So why do prices fall while stress rises? Because price reflects leveraged paper traders. Stress reflects physical availability. When the CME raises margins, weak hands are forced out. Retail investors, small funds, anyone using leverage without deep pockets, they sell. Prices fall. The headlines say the rally is over. But strong hands don't sell. Central banks don't sell. Sovereign wealth funds don't sell. Industrial users who need silver for solar panels and semiconductors don't sell. They accumulate quietly while the market looks weak. This is not conspiracy. This is how markets work before major breaks. Prices are made to look weak. Sentiment is crushed. And then when no one expects it, the break happens. Not in price, in trust. Let's ask the real question. The question that matters. It's not whether silver goes up. It's not whether you should buy or sell. The real question is this. What happens if trust in fiat currency and liquidity, in the settlement system itself, fails? What happens if the paper market loses credibility? Gold is a central bank asset. It sits on balance sheets. It is recognized as money. It has a lender of last resort. Central banks can intervene. They can stabilize the gold market if they choose. Silver has no such backstop. Silver is industrial, monetary, but unofficial. It has no lender of last resort. When stress hits the silver market, there is no one to call. The system is on its own, and that makes silver the pressure point, the place where cracks appear first, the canary in the coal mine of the monetary system. Let's look at history, not to predict, but to observe. In 1980, lease rates spiked, backwardation appeared, and prices initially fell, then they exploded to $50 before the exchange intervened. In 2011, silver rallied to $49. Lease rates rose, backwardation flickered. The CME raised margins 5 times in 9 days. Silver collapsed. The pattern repeats. Stress, intervention, collapse. And then in the aftermath, the question, was the stress real or was it manufactured? We don't know. What we know is that the conditions today are different. The supply deficit is real. 230 million ounces short in 2025 alone. 5 consecutive years of deficits. Mine production has not kept pace with demand. Industrial consumption from solar, electric vehicles, and data centers is accelerating, and above-ground inventories are at multi-decade lows. This is not speculation. This is the Silver Institute's data. This is the London Bullion Market Association's research. The deficit is structural. It is not going away. And when a market runs a structural deficit while operating on a fractional reserve model, something has to give. Either supply increases, or demand decreases, or the pricing mechanism breaks. Elon Musk understands this. On December 28, 2025, he posted on X, "This is not good. Silver is needed in many industrial processes." He was responding to news that China would impose export restrictions on silver starting January 1st, 2026. Licenses required. Minimum production thresholds, credit lines, state approval, the details matter. Under the new rules, only companies producing at least 80 metric tons annually and holding $30 million in credit lines can export silver. That effectively blocks small and mid-sized exporters, the companies that provided flexibility to the global market, the marginal suppliers who would step in during shortages, gone overnight. The effect? China, which processes 60 to 70% of the world's silver, is restricting supply. At the same time that global demand is spiking, at the same time that Western nations are trying to secure critical minerals for national security, at the same time that the green energy transition depends on uninterrupted silver supply, China is tightening the valve. Is this about environmental protection, as Beijing claims? Or is it resource nationalism, a strategic move to secure silver for China's own solar industry, its own electric vehicle ambitions, its own technological ascendancy? We don't know. What we know is that when the world's largest processor of a critical mineral restricts exports, the global market adjusts, or breaks. Musk's concern is not philosophical. Tesla uses 25 to 50 grams of silver per electric vehicle. At $80 per ounce, that adds hundreds of dollars to the cost of every car. Scale that across millions of vehicles, across the entire EV industry, across solar installations. The supply squeeze is not a distant risk. It is a present cost. It's not theoretical. It's on the balance sheet. It's in the cost of goods sold. It's in the margin compression that companies will report in their next earnings calls. And this is happening while inventories are already depleted, while lease rates are already elevated, while the London market is already stressed. China's export restrictions are not creating a new problem. They are compounding an existing crisis, pouring gasoline on a fire that was already burning. And yet, prices are falling, because the paper market said so. Let's return to Robert Gottlieb. In late December, as silver was surging toward $84, Gottlieb posted on LinkedIn. He warned of extreme tariff risk disrupting arbitrage between London and New York. He explained why lease rates remained elevated even as prices corrected. He described a market where the normal mechanisms, borrow, ship, deliver, were breaking down, where the cost of hedging had become prohibitive, where even bullion banks were reluctant to quote each other. This is the man who once ran this market. And he is saying it is no longer functioning as designed. Some will dismiss this. They'll say Gottlieb is promoting a book, that he's building a profile, that he has an agenda, maybe, but the data supports him. The lease rates are real. The backwardation is real. The Shanghai premiums are real. The CME margin hikes are real. The deficit is real. At some point, you have to ask, what if he's right? What if there really is no free-floating silver left? What if the vaults are empty of anything that can be easily mobilized? What if the fractional reserve system, built on the assumption that not everyone asks for delivery at once, is about to be tested? And what if it fails? The unsettling part is not the price crash. Markets crash. Volatility happens. Corrections are normal. The unsettling part is that the crash came at the moment of maximum stress, when lease rates were elevated, when backwardation persisted, when insiders were warning. when physical premiums in Shanghai were at record highs, when vaults were reporting difficulty sourcing metal. The price fell, but the stress didn't. If this were a normal correction, everything would normalize. Lease rates would collapse back to near zero, backwardation would vanish, the market would return to contango, metal would flow freely between London, New York, and Shanghai, the premiums would disappear, the warnings would stop, none of that happened. The dislocation remains, the premiums remain, the warnings remain. Gottlieb is still posting about structural tightness. Lease rates are still elevated, the Shanghai premium is still there. The backwardation, while less extreme, has not fully resolved. The arbitrage trades that normally restore equilibrium are still hampered by tariff uncertainty and financing costs. This is not normal. This is not how markets behave after a simple correction. This is how markets behave when the underlying structure is changing or breaking. This is not a prediction. This is an observation. Something is different this time. The market is not behaving the way it should. The playbook says, raise margins, crush the rally, everything normalizes. That's what happened in 1980. That's what happened in 2011. But it's not happening now. The rally is broken. But the stress is not. And when markets don't behave, it's because the underlying structure is changing or breaking. Either we are witnessing the birth of a new pricing regime, where physical and paper trade at persistent premiums to each other, or we are watching the slow-motion failure of a system that can no longer reconcile the two. Silver may fall further. Prices may test $60, $50. Volatility may increase. The headlines may declare the rally over. The skeptics may claim vindication. But if Robert Gottlieb is right, if the insiders are right, the real collapse won't be in price. It will be in trust. Trust that the paper market represents the physical market. Trust that contracts can be settled. Trust that the system works. And when trust breaks, price becomes irrelevant, because there is no price for what cannot be delivered. That is the warning. That is the risk. That is what makes this moment different from every other silver rally in history. Not the price, the structure. The system itself is under stress, and stress, when it's ignored long enough, becomes failure. Watch the lease rates, watch the backwardation, watch whether metal continues to flow freely or whether the dislocations widen, watch whether the paper market and the physical market continue to diverge, and ask yourself, in a world where trust is the only thing holding the system together, what happens when trust is gone? Silver is crashing, but the system may be breaking, both are true, and that is the most unsettling thing of all. See you in the next video.